Ricky, how we doing? Welcome everybody. All two of you. Yeah, man, I didn't even really get a trade today. Unfortunately, it looks like it was an easy one though. We got a trade basically the first half hour, 45 minutes of the day, and then had a bunch of stuff come up. Seems like a lot of people in there. I want to read the report, quite the ripper out of it, no doubt. Damn, 16 billion in net deposits too. That's big. 193 billion in assets. Wow. Wow, gap EPS 1.01 versus the 4 point or 0.42 estimate. Sales beat by 60 million. Those are good numbers. Welcome everybody. Got the link posted a little bit late, but we'll get rolling here soon. I know there's only a few of us in here. Hopefully we'll get a couple more people in here. I know attendance has been really down in the classes the last couple weeks. I think people have had a hard time trading lately. Yeah, been a tricky one. I think a lot of people getting real loud and then end up being wrong and get real quiet. It's just kind of those cycles that we go through here. Trade floor was going off there for a while, and then it's kind of getting quieted down a bit again, you know. But I normally get, I don't know, 50 or 60 people in my classes, somewhere around there, 45 to 60 people. And the last couple of weeks we've had like 30. So definitely much lower attendance than normal. Last class, yeah, I got 10 weeks or something like that. Time flies, you know. I don't exactly remember when we started this even, but yep, last one. And then this one's just kind of, it's it's an interesting class. Uh it's a bit more this is technical. Is this something that you like need for the market? Absolutely not. It's something that I enjoy. It's something that I like to watch. And it just kind of gives you that additional view of what's going on in the market as a whole. So I like to watch these things. I've done this class, a couple times over the last few years, and the first time nobody came. The second time it was packed. So we'll see how this goes on the third time. It can be the things that we're going to talk tonight. They are, I think they're important tools. I think they just, they can give you a big picture view of the market, and we'll get into all of this again here in a minute. They can give you a good big picture view of the market at a quick glance, which is that's how I like to use what we're going to be talking tonight. Yep, I'll still do classes every single week. This was just uh really about once a year or so, I'm going to try to do this beginner series. And the last time we had done it was kind of the spring of last year. And so we just started it up again this winter. Just so happened Toasty was going to do a beginner one too. So we just had, big focus on learning over the last little bit. But yep, I'll continue to be doing classes. These ones were, all building on each other. So of course, they won't always be like that. I just teach the classes on the things that I want to teach. I'm lucky enough that MMA and Talia know that if I'm going to teach something, it's, at least hopefully worth knowing. And I'll be a good teacher of whatever I'm trying to teach. As most of you guys know, if I don't know something, I am the very first person to admit that I don't know about it, and I won't, answer questions or anything. So I'm lucky enough that for the classes that I teach, I try to teach things that I not only like to talk about, but if people have requests, I frequently will know at least a little bit about something, often enough to teach a class. So they tend to come to me when people do have those requests. For the classes that I was doing weekly, like I said, it's just kind of, I don't want to say it's random. I typically, try to have some good ideas going in there. But then for the last about 10 weeks or so, I've been doing just, I don't want to call it a beginner series, but just kind of a more focused thing on how I trade, the things that I look for, how I do everything. And, it of course starts with the simplest, but the most important, support and resistance. And then now we're making it all the way to, this is some more advanced stuff in the market. Like I said, do you need it? Who knows? But it's something that I like to teach about. So we'll see. But this is also a good class because, well, generally, unless there's, questions, and of course, feel free to ask any questions when you're in here. But this is generally a class that, I mean, it only takes maybe half hour, 45 minutes. So we end up just checking out some charts after this. And then for me, I miss most of the day. So I'd like to go back and kind of see what happens. So I'll just be looking at charts that either I pull up or you guys want to look at towards the end. Give me 1 second and we'll get started here. Okay, just doing a couple things. Give me 1 more second and we will get to rolling. Okay, and give me just 1 second here. Sorry, Dusty sent me some videos making me laugh too. Okay, welcome everybody. Happy to have you here, Dirty River. So tonight, as I said, kind of the final class of our series, as I was talking a little bit before, we were starting, is this super important for you in the market? No, it's just, these are tools that I think all trades and everything you do in the market, you want to have as many forms of confirmation as you can. And so these are just some things that I personally watch. Some of them I watch all day. We'll talk about the ones that I care about all day. We'll talk about the ones that I mostly am watching on longer time frames, that kind of stuff. Most of them I'm watching on longer time frames and how I use them. And what and tonight it's for anybody who doesn't know, market internals. So again, Dirty River, happy to have you here. And we'll get going. So we're talking market internals. And what do I mean when I say, or when you hear other people say market internals? And really what they are is to give you a really big picture view of the market. We'll get into more detail of what each of them do, but we're going to talk about ADD, Tick, and VIX. Those are the three that we're going to cover tonight. We're going to, and I'm going to explain to them how I or explain to you how I use them, what they mean to me, some, common misconceptions from them, and how can we use this in our trading? And a lot of people, a very common statement that you'll hear from people is they'll talk about things being overbought or oversold. And obviously, in OOT, we're mostly focused on derivative trading, so time sensitive sort of stuff. And so we hear a little bit less about overbought or oversold conditions. Sometimes you will hear people discussing it in relation to RSI. I'm obviously not a RSI trader. RSI is just one that to me I've never understood why. You know, if I see a stock just absolutely flying to the upside, I probably don't need an indicator to tell me that it's overbought. So RSI has never done anything for me, especially on the shorter time frames. So if you ever hear me discussing overbought or oversold conditions, when I'm saying that, it is likely from something that I'm seeing on market internals. So when I say something like that, it is more of a broad market view. That's what I use these things for, is I'm able to pull up these charts, and we're going to pull up the charts and we're going to look at them tonight. They're super weird looking charts, all of them, and so, well, VIX is somewhat normal looking until you realize what's going on and you realize the numbers are just kind of there for fun. But tonight we're going to be talking these weird charts and what we can gather from them. The big advantage of them, and I understand that it'll take your eyes a second. You aren't going to go through this class and be able to just glance at these things and know instantly what they're telling you. But as over time, as you start to use some of these market internals, you'll see that you don't need them on big charts. You don't need any of that stuff. You don't need to be dedicating a bunch of screen space to them. I personally have them on, I use Thinkorswim, and so I just have them pop out of the little sidebar. And when I want to look at them, I click the little arrow and open the sidebar so that I can look at those charts. Otherwise, I have them gone, because they aren't something that you need to sit and stare at all day long. Most of them, ADD, Tick, VIX, all of them, they don't, you know, they don't tell you much on the shorter time frames. Early in the day, they can kind of give you some hints of what might be coming before it starts. But it's not something, these aren't things that you need to be looking at all day long and just like, oh, VIX is popping, VIX is, oh, green candle on VIX. You don't need to worry about that kind of stuff. These are just to say, okay, I'm trading SPY. I have, a bunch of my big names on support. And of course, this is all building on our previous classes. So, we know, okay, we want to trade SPY. We're trying to buy a dip on SPY. All of our big names have pulled back to a support, an EMA, a VWAP, something like that. We now have SPY pulling back to a support. So this is when we might start to say, okay, where can I get some more confirmation that it's worth it to get long? And so one of the first places that I'm going to look in regards to market internals is going to be ADD. And so, and I know, that's just what it is. So that's called ADD. It's advancing declining issues. It's the advanced decline line. It tells us what is ADD. It tells us I think, feel free to double check me on this number if I'm wrong. I won't be offended. But I think there's about 2,800 stocks in the New York Stock Exchange. That's how many are trading on the NYSE. And ADD is tracking all 28 of those stocks. And so when we pull up the chart, as I said, it's going to look weird. Here is the chart on ADD. So you can see I have this line in the middle. It's actually at 0.06. Doesn't matter. This isn't actually a technical level. This is 0 on the ADD chart. So I know that for us in stocks, it's oftentimes we don't see negative numbers unless it's a trade, but we don't see negative numbers on a chart. So when you pull up the ADD chart, it can look very weird because it is oftentimes going to have very large gaps on it. And you might get way down into negative territory. You might get way up into positive territory from negative territory. Well, what is this actually teaching us or showing us is of those 2,800 stocks in the New York Stock Exchange, what's the difference of how many are trading above yesterday's close and how many are trading below yesterday's close? So basically, what that is how many stocks are green on the day and how many stocks are red on the day that are traded on the NYSE. And again, 2,800 stocks or so. So how can we use this and what are some things we can actually got to get these indicators off. You never want to use indicators on this type of stuff. How can we use this and what is it telling us? And why does any of this matter? And as I said, do you need to have this in your trading repertoire? Not necessarily. I like to use it because I like to analyze the whole market. So I am able to look at this chart right here and identify what most of the stocks in the market are doing. And so that is what I use it for. And so what are we seeing here? And we're just going to use, today as the example. What are we seeing here? Well, we can see yesterday into close, there was not a lot going on in the market. We were pretty well flat on ADD. When you're at zero or right around zero in ADD, you know that, you know, some stocks are red, some stocks are green. Most things are trading, you don't have this oh, the market is absolutely flying. Everything is big and green. You don't have, oh, the market is dumping. We had a lot of not much going on yesterday. A lot of stocks end in the day flat, maybe slightly green. We can see here, basically by the end of the day, about 1,400 of the New York Stock Exchange stocks were green and 1,400 of them were red. And we were sitting right at zero because it was, pretty 50-50 in the market yesterday. There's, of course, some big rippers, but we're able to look at this and say, okay, market's kind of flat. So, maybe we don't care much about ADD. Well, where we start to care is when we get to these extremes. And you can see the numbers actually go way beyond 2,800. I don't know why, but we want to pay attention to the extremes. And like I said, I think it's 2,800 stocks, maybe it's 2,600 stocks in the New York Stock Exchange. I think it's 2,800 stocks. You can see when we're way down here and we know, okay, 2,000 stocks are currently trading below where they closed yesterday. Makes perfect sense when we pull up next to it. If we pull up the SPY chart, and let's see, I'm just going to wait, this ain't about TA on SPY tonight. So when we pull up the SPY chart, obviously on the back of that big, or the CPI report coming in slightly hot. I don't know why it's such, obviously the market didn't care in the end, but when we pull up the SPY chart, we had a big gap down. We had a $6 gap down on SPY. So we can look at this and ADD is telling us that. Well, now is when it starts to become a useful tool. You guys know in my trading how I like to trade. Everything I like to look for, I like to trade at extremes. I like to buy dips. I like to short the big old rips, when given a reason. That's how I like to trade because the risk is minimized and the reward is maximized. Well, you aren't obviously going to trade ADD, but you can look at it and say, okay, we've gapped down to the extreme. There's, 2/3 of the stocks in the market are now red on the day, which makes sense with the big old gap down. Well, we can see in ADD, they started buying right off the open. Today obviously is one of those days on SPY where, they started buying right off the open on SPY as well. Well, I start to look at ADD and say, okay, how are stocks doing now? And we can see by the first hour of the day, they have already flipped basically 600 of the stocks that were red have now gone green. So as we're going up, we can use ADD to tell us, hey, there's big buying going on in the market. Market wide, we are seeing buying, and we push up again and we know that by, basically lunchtime, East Coast time, noon, 1 o'clock East Coast time, we can see, okay, they've bought 1,000 stocks in the market from red to green at this point. And now, even though we're trading way down here red, there is still a ton of stocks that have now gone green on the day. So, and then of course, we kind of level out because that's a nice turnaround. You can't expect everybody to turn around. You still got 1,700 stocks red on the day, obviously, So we can use ADD to tell us, are they really buying the market? Is this, because it's always rough when, maybe you're looking to buy the dip and a couple names are flying, but maybe not very many names are flying. Well, ADD can be the one to tell you, okay, be careful buying the dip because there's not too much buying going on. Here's another great example on ADD. We had this is a couple days ago. I don't know what day this was. This will be on the 10th. So on Monday, maybe. So on Monday, we can see, obviously big gap up, $5 gap up or whatever it was, $4 gap up. And then we come into the open and we immediately see off of the open that we've now had 700 stocks flip red on the day. And this is one of those examples where you look at ADD early in the day, you see that selling, and then it starts to go sideways. And so what this is telling us is that there is more stocks in the market trading green than red on the day. So even when you're seeing these sell-offs, you can still relatively comfortably remain a dip buyer. Of course, you aren't getting a ton of information on this. So that's why I want to show you see big selling and the selling stops and it just starts going sideways. That's when you can kind of start to say, hey, maybe we're going to see some ranged activity. I'm going to stay slightly bullish on the day because ADD is telling me there's still more buying going on than there is selling. And so we just kind of flatten out. So this is a really great example of early in the day, it told you were going to get some knives. Obviously, we get those knives right off the open. And then it starts going sideways, still positive. So we don't need to look at it again. You don't need to have this chart up all day. You don't need to do any of that. I saw some like meme of a guy who watches like 15 time frames of VIX. You don't ever need to do that necessarily. It's not going to help you. You want to use ADD or VIX or the other ones we're going to get into tonight. You want to use ADD to, I'm trying to see what day this is, the 4th. You want to use ADD to give you the broad view of the market. You can glance at it. Here's a ripper day. We gap up. And so we take our gap up. There is nonstop buying going on in the market. So and you can see when we take the little gap up, SPY's not doing a whole lot. SPY goes straight sideways for a few minutes. While they are on ADD, they are buying everything in the market. We have gone from more stocks red on the day, even with the gap up, to over 2/3 of the stocks, half the stocks in the entire NYSE are now trading green on the day. And SPY didn't, SPY gave you time. SPY gave you time. When you see this kind of buying, you are often able to, if you catch some consolidation, this is wonderful example of additional confirmation provided by ADD. All it takes is one quick glance. You pull up your chart, you see the just insane buying going on. Of course, there's no volume. That's not how it works, but you see the insane buying going on and you can start to feel pretty comfortable and say, hey, I want to be long in the market because they're longing everything in the market. And ultimately you catch that nice big old run. And then of course you get some more pushes, but you mostly flatten out for the rest of the day. And you can see still, even as that day progressed, dip buyers were the ones that were mostly rewarded, some dips down to VWAP, dips down to these EMAs. The dip buyers were mostly rewarded for the rest of the day. But ADD told you the buying was going on before SPY told you the buying was going on. So that's how I like to use ADD. Again, is it super necessary? Is it something you need to pour over every single day? Absolutely not. In fact, you shouldn't. You should simply look at it every once in a while and say, okay, there's a lot of buying going on. There's a lot of selling going on. ADD tells me that in a very quick manner. And that's all we need to care about with it. You don't need to get tied up into what the numbers are, what the numbers represent. You need to say, what is the trend of ADD? If it's mostly pointed up and there's mostly buying going on, then you can start to look to buy some of those dips in the market. If it is mostly selling going on, you can look to short some of those rips in the market. So does everybody get it? Again, relatively simple, not something, not something to pour over every single day, just gives you that, big view of the market. What are the 2,800 NYSE stocks doing? Everybody get it? Yep, perfect. Okay. Take the no answer as a good answer. So next one we're going to discuss is tick. So And then I meant to mention this earlier. So on ADD, on Tick, if you're on Thinkorswim, the thing that you need to put in is, or the ticker that it's hard when ticker that you need to put in money sign Tick or money sign ADD. You can't just type in ADD or Tick. I got a direct message. Somebody asked me this, and so I'm realizing I should have said it. So you can't just type ADD or Tick. You got to put the money sign first. So next one that we're going to talk about is Tick. And so as I, gave the warning early in the class, these charts are very, very weird looking. Tick, obviously the weirdest. Is there a historical average for ADD? I mean, I don't know about a historical average, but you can, those are the intraday ones. If you pull up the daily one, this is what it looks like. So I'm actually happy you asked this just because I meant to mention it, this is where I'm going to look for those overbought and oversold conditions. I obviously forgot to mention this. So again, thank you for bringing it up again. I go to the daily and I look for overbought and oversold conditions here. If we're getting a bunch of daily candles closing down here, we're oversold in the market. If we're getting a bunch of daily candles closing up here, we're overbought in the market. I'm not going to take a long or a short on that, but I'm going to use it to look and say, what is the market doing? Where is the buying going on? But as far as getting a historical average, I'm sure there is one. I've never looked into it, but it would be tricky math because I mean, we can even use these like past couple days, yes, we gapped way down. Yes, we were down there around that 2000 where you should obviously be pretty careful getting short on, even if on nothing else, for a relief bounce. But this was a strong day in the market. When you just look at the chart, this was a nice strong day in the market. $4 or $5 rally. I mean, that's a great day in the market. ADD wouldn't. You might not know that. I mean, you can see this green chart or this green bar down here, but you can also, assume that, okay, well, there was only so many stocks trading green on the day. So the long time frame average might get to be a little bit confusing on it just because a good day might be represented as a bad day, sort of thing. It's just that weird market stuff. But I don't have the answer for, is there a historical average? I'm probably going to Google it when I'm done. Okay, so with that, Tick. As I said, this is the weirdest of the weird charts. Okay, so you'll notice again, zero line. Obviously, mine's a 1.02. It is there for nothing besides for you all to see it in this class. I don't actually, and I'm going to move it to zero just so we see. You don't do TA on something like, Tick or ADD or anything like that. They don't have supports. They don't have resistances. Zero is just the line that is right in the middle. So when I watch Tick and ADD, I'll watch on the 5-minute, 15-minute, 30-minute, whatever you like. It doesn't especially matter. I think normally mine is on the 5 or 15-minute, oftentimes even just the 5. When I look at Tick, I won't go lower than 15-minute, and you can go longer if you want. But what is Tick showing us? So it's a weird one. The chart is very weird. It is telling us so a tick in the market is an exchange of a share. That's what an actual tick is. So what it is telling us is, are there more shares being exchanged on upticks? So if I have a share of SPY for sale and I sell it for $602, and then the next share of SPY after me, and you have to think this is millions of shares every day. The next share of SPY after me is sold at 602 and 1 penny. That is an uptick in the market. So it will be represented as green. So again, Tick is tracking the same thing as ADD. It's tracking the stocks in the New York Stock Exchange, and it is telling us, are more of them on upticks or are more of them on downticks? And so how do we use this in our favor? We know that if an uptick is printing, the price is going up. if a downtick is printing, then it is likely going down. This is a little bit different than, your time in sales, where, a downtick can also be a buy on the way down. There's those kinds of things. But this is telling us, did the transaction happen at a higher or lower price? And it's tracking all of again, those 2,800 stocks in the New York Stock Exchange. How I like to use this, and again, this is one that I don't watch it a ton by any means, because this is the one that I use for intraday. Are we overbought or are we oversold? And this is not, you don't use tick looking for a reversal. You don't use it for anything like that, but you use it as do I need to ease off on my longs? Should I be trimming my longs? And so when you're looking at these numbers, again, we got zero line goes, very high numbers. You'll never see them. But we got zero line in tick. Anything that is anything above 1,000 or anything below 1,000 is overbought or oversold conditions. So this is for me, if I'm going to use any sort of intraday indicator or anything like that to tell me overbought or oversold conditions, for me, it is always going to be using tick, because it tells me when you're getting those extreme volatile pops. Are you getting a big pop? Are you getting a big dump? Are they showing up and buying early? This is one where on today, obviously and I'm going to the shorter time frame. Again, I mostly watch it on the 15-minute. We'll kind of get into that why here in a second. But when you're watching this, we can see SPY off the open. We had that big red wick down right off the open. Tick didn't agree. Tick told us, like, there's no wick off the bottom. We gapped down and opened here, and they hammered the buy button on every single thing. Well, we know that we just watched, we had 1,800 of the stocks, we had 1,800-ish of the stocks, 1,700 of the stocks on gapping down. And all of a sudden they bought, 800 of them ticking up. So we know they're buying everything. And this very, very likely, I didn't trade the open today. I do use this almost every morning on the open. This very, very likely told you while this thing was deep red, they were hammering this long and they were buying everything in the market. So tick very, very quickly tells you, okay, they are buying. You can try this little dip buy down here, stops below those lows. It's that simple. You are in extreme oversold conditions, being down here at minus 1646, anything below 1,000 is oversold. So when you're $650 past, or well, not dollars, points past 1,000, you are in oversold territory, and you can look to, try to catch little bouts. You of course aren't looking necessarily for a reversal, but you can use it to say, okay, they're going to start buying in the market. Well, how do I start to use this intraday? And for me, the main times, end of day is tricky, high volume, a lot of ups and downs. When I like to use it is I just like to see if we're pushing to these extremes. So, you can see very, very frequently when we start to push to these highs is when we're going to falter a little bit. So, this is when we're pushing up to these highs, we're getting these overbought conditions. SPY does a little consolidation. You obviously don't flip bearish or anything because of that, but you just say, okay, we keep pushing these overbought conditions. We need at least a little pullback to buy. And then ultimately that's what you got. You got a nice little pullback to buy. And then again, big spike up to those almost overbought conditions. And that's where we kind of topped in the market today. Obviously not like a top, but like some clobber off there or anything. But we pushed those highs and we just couldn't get past them. We didn't have that strength to keep the dip buy really ripping us up into close. And so that's how I use tick. That's all I care about is show me the extremes. So sometimes we're just going sideways or you aren't ever really pushing those extremes. Those are often days, kind of choppy days. You can see, the one big strong wick up obviously coincides with that late wick in the day. But that's it. A lot of the time you aren't going to be able to get a ton of information on this. Obviously on some of these, this is another one, I'm seeing it. So obviously on some of these days, this is actually a nice example. So gap up into overbought conditions, instantly start selling. So we get the nice little pullback. Well, now this is why I start to like the longer time frames. So we get the nice little pullback. This is the we get the nice little pullback. And now on this longer time frame, like I said, you don't bury your nose in tick all day. Your eyes will hurt by the end of the day. But you look at this and you say, what are these candles doing? And all we have to do is look at them and say, most of these 15-minute candles are spending most of their time above zero. That means for the most part, people are on the buying end of things. So we can see a lot of candle closes, most of the candle bodies, most of the wicks. We have a couple closes down here, obviously on some of these dips, but they're instantly bought back up to where everything is ticking to the upside. That's really all I use it for. I want to see those extremes. Are we blowing way out of the highs? Are we blowing way out of the lows? And where are most of the candles closing? Maybe you don't even like looking at the 15-minute, and you would much rather look at maybe like the 30-minute more. You can still do the same thing. Where is the bulk of the stuff on the day above the zero line? Let's go back and see if we can find a nice, oh well, the day before. So on the day before, well, the Friday before, now we see most of the stuff below zero. And obviously some pushes to those extremes. So this was obviously, this was tariff day, but we can see here, most of the bodies, most of the closes, most of the actual time other than volatile wicks are spent below zero. So we know for the most part, things are happening on the downticks in the market, which we can likely assume are sells. And ultimately, we saw that selling all day. We didn't get one 30-minute body close over zero. So that means every 30 minutes at least, we were for the most part down on that entire day. So that's how I like to use tick. Again, is it super, super necessary? No, but it's another really great tool to say, is the market overbought? Is the market oversold? And what are what are these 2,800 stocks doing? And you can do it at a glance. Even if we were halfway through this day, we can say, oh yeah, they're selling. They're spending most of their time selling. Like it takes 1 second to identify that. On maybe a choppier day, more sideways day, sideways to up, spend a lot of time with these bodies opening and closing right around zero or slightly above. So just use it as something to glance at it, get your big picture view, and move on. So everybody get that one? Obviously, it's the most hideous chart around. I had a buddy who watched the 1 minute on it. It was like, I can't even imagine watching this thing all day. Yep, everybody get that one? Everybody get that one? No questions? Again, just in simple terms, look for the overextensions, and that's it. And I should say, don't short because we're overbought. Don't long because we're oversold. But it's more, hey, if we have a lot of buying, don't rush into longs at the overbought. This is a great way to say, I feel comfortable buying the dip, of course, but I'm not going to buy it when we're pushing the overbought conditions because the market likely pulls back. Okay, good. So everybody got it. Final one we're going to talk. I should get rid of that. Well, final one we're going to talk, and I will get rid of it, is VIX. So it's VIX. It is the volatility tracker of the market. It is something tons of people talk about it. Tons of people care about it. Tons of people have opinions based on it. They are almost all wrong. They don't, one of the most common misconceptions with VIX, the volatility indicator, and we're actually going to talk about, I personally don't necessarily watch VIX. We'll get into that in 1 second. But a lot of people talk about, oh, well, if VIX goes up, SPY goes down. If SPY goes down, or if VIX goes down, SPY is going to go up. Actually, like 40% of the time, I think is the statistic. Again, feel free to double check me as always if I'm, I could be wrong, but I think it's about 40% of the time they move in the same direction. So intraday stuff on VIX very, very rarely matters. Another thing you do not do technical analysis on VIX. You might see, oh, there's a flag or there's a pennant or whatever on VIX. If somebody's telling you that, likely quit listening to them. If you tried to trade, like VIX was sideways for, months and months and months and months. I mean, if you were trying to trade VIX down here, you were just demolished, like, oh, the trend broke and it did nothing. It went sideways for another week. And then we get a little news pop. You don't do technical analysis on VIX. What, in my opinion, you care about. And I'm putting these on the chart for reference more than anything else. You care about the major round numbers, your 10s, your 15s, your 20s, VIX over 20, there's some volatility in the market. Well, it still doesn't necessarily mean SPY's coming down, SPY's coming up. Oh, huge gap down on VIX. It's going to fly. You never know when you get these insane spikes. This was obviously that carry trade unwind. You never know when you're going to get those insane spikes. VIX is telling us something much simpler than people think. And it is, it is one of the most like widely misused things that I see personally in trading. What VIX is actually telling us is it really has nothing to do with today or tomorrow or next week. What the numbers on VIX tell us are the expected volatility over the next 30 days. And how do they calculate it? They actually go to the front month. So, we're in February. They go to the March monthly expirations on SPX. And they use the spread of basically an at the money strangle. And the difference is the expectation of volatility. So, and it's much more advanced math than that, but that is all they are telling us is if VIX is at these levels, how much movement is expected and is being priced in the market. This can start to affect, implied volatility. It'll start to affect option contract pricing, all of that stuff. Higher VIX means more volatility is expensive. So when, I'm sure that anybody in here that's traded SPY or QQQ after some really big moves in the market, they say, why are SPY contracts so expensive? If you ever have a day where SPY contracts seem expensive to you, go look at the VIX. And there's a very good chance that the VIX is elevated because when it's elevated, we know that there's more volatility expected in the market. So you pay more for those contracts. But all it is telling us is the expected move over the following month. So intraday, do we ever care if VIX has a bear flag or anything like that? Absolutely not. And so there used to be a person in here. She unfortunately left, but Tori, I'm sure some folks know her. She's awesome. She found somewhere, couldn't tell you where, a cheat sheet for the VIX. And so that's what I'm sharing right here. If anybody wants a copy of it, I would love to share it with you. It's a really, really great thing to look at. And so this tells us here's the VIX number, the price of VIX. You'll notice that VIX has no volume. We're going to talk about that in a second, but the price of VIX and the probabilities of the expected moves. So, when we have a, 14, 15 VIX, what they're saying is there's a 68% chance that over the next 30 days, SPY will either be up or down 4%. That's their expectations. It could be 1%, it could be, up 1%, it could be down 0.5%, but there is a 68% chance that we're going to fall within 4%. As you can see, if you start to widen those percents out, there's a 95% chance with VIX at 14 that SPY is going to be up or down 8%. That's pretty obvious. That's all VIX is telling us. Again, there's a 99% chance that if VIX is at 15, we will be within a 12% range. This is SPY. Of course, that's why it's a 99% chance. I do love this as disclaimer at the bottom. Remember that roughly 1% of the time, SPX will fall outside these ranges. 1% is not 0%. And that's what they're hinting at here. It might be a 99 chance, but those 1% happen. So this is all VIX is telling us. And if you go back historically and look at how accurate this is, it is mind-blowing. I mean, it is very, very consistently right. We saw it we saw it all through 20, well, end of 2022, all the way through to about the middle of 2024, even middle end of 2024 until, uncertainty showed back up. The VIX was low. Obviously, like I said, we had that carry trade unwind, but for the most part, other than some uh oh, this was the banking stuff, other than some little pops up, it was spending, VIX was spending most of its life down there in this, like, tons of time between basically 12 and we'll say 15, $16. And we know from our cheat sheet that that means very high probability SPY is going to be up or down in the 4% range. That is all VIX is telling us. It's not some, you know, manipulated indicator or anything like that. It is just telling us, what do the spreads on the front month SPX contracts tell us? How much volatility is there going to be? So that is how VIX actually tracks volatility. That's it. And we can even see, when you look at this VIX chart, there's some pops that happen. A lot of these days, SPY was likely going up and VIX was going up. And all that was some expected volatility in the market. That's why you want to be careful. Obviously, the very large spikes in VIX are oftentimes met with big sell-offs, but that's why you want to be careful just saying, oh, VIX up, SPY down, VIX down, SPY up. You can't quite be that cut and dry with it. So yeah, what do these numbers mean? It's literally just telling you the probability, and the real probability, not based on feelings. This is based on 40 years of data, tons of math, blah, blah, blah. So it is telling us that over the next 30 days, there's a 68% chance that SPY will, and we'll say VIX at 15, that SPY will either be in the range of down 4.3% or up 4.3%. That is all it's telling us, which is very, very likely. So there's volatility traders out there. Some volatility people that I really like are the Nigerian brothers. They're kind of annoying, but like they're pretty full of themselves, but they're phenomenal at trading volatility. And so one of the ways that they like to use VIX, and many other traders like to use VIX, is, if we are in bull markets or bear markets or whatever it is, and, you're expecting the upside or the downside, well, you use these probabilities in your favor. Say that you want to be in some SPY calls, and that you don't want to go beyond this. There's a very low probability that you're going to get outside of a 4.3% move up or down, barring some crazy moves in the market, crazy news, whatever it might be. And so, because 4% is a giant move, and so how you can use that is say, okay, well, maybe I want to get in some SPY calls, but I want probabilities in my favor. So over the next month, I have about a 70% chance that best case scenario SPY's up 4%, worst case scenario SPY's down 4%, but I can trade pretty safely in that range without getting beyond what the market is pricing in. That's what the market tells us, because we get that VIX number based on what big money is doing with SPX. If they are expecting a lot of volatility and that, the VIX number is going up, they aren't saying it's going to go 6%, but they're saying if things really, really, really go crazy, it could go up or down 6%. Then again, next column, 95% chance. So this is telling us there's a 95 with VIX at 15, there's a 95% chance that it's going to be between, 8.6 up or down percent. It's kind of a no-brainer. It's a relatively, this is why I like to talk about VIX, because people put a ton of weight on it, but it's more telling you like a very, very obvious fact, like, yeah, there's a 95% chance that SPY isn't going to be up or down 8% in the next 30 days. That's basically a guarantee in the market. Of course, nothing's a guarantee in the market. However, where we start to, take advantage of this is, yeah, we know at 14, there's a 95% chance it's going to be between that, that big of a percentage. Well, you see VIX taking these big spikes. You see VIX at 21, and all of a sudden, there's the chance of a 6% move that the market is pricing in. So we can trade around that. We can say, okay, there's some expected volatility. Maybe I'm expecting it, a big volatile bounce, a big volatile sell, whatever it might be. VIX is at 21. I know and not only mine, but the market makers, their idea of the maximum range. So that's how we want to use VIX. We don't we don't necessarily care about the 95. We don't care about the 99% chance. Like, yeah, VIX is at 15, and it's probably higher than a 99% chance that it ain't moving up or down 12%. That's a gigantic move in the market. But we want to take advantage of this 68% column where, okay, VIX is getting elevated. If we're in a bull market and we're getting this big spike in VIX, and maybe we're seeing a pretty dramatic sell-off, and we know that there's some percentages to recover. We got the 70% chance we'll be in a 12% range. So if we see a little 3% pullback, we can start to say, or 2%, whatever it is, well, now we got 8% potential upside. That's how we want to use it. Okay, and so well, because so well, we'll do made up numbers. So at 68% chance, let's say SPY trades at $100. That basically means that, hey, over the next 30 days, SPY is going to be up or down. SPY will very likely be up $4 or down $4. That's good. That's a usable amount of range for us. Well, when we come over here and we say there's a 99% chance that SPY will be up or down, it's worth $100 and it'll be up or down $12. That's just a no-brainer. Because it's a bigger range. The chance that SPY is going to move 4% is substantially lower than the chance of SPY moving 12%. So that's why when you see the higher percentage here, it's accompanied with a much wider range. Because of course, like, this is giving you virtually a 24% range on SPY. I've been trading for quite a while. I've never seen a 24% weak on SPY. So that's how they give you 99% chance, because that's an extremely unlikely scenario. So as I said, this column, not of a ton of interest to us. This column, not of a ton of interest to us. This column over here starts to hold some interest because these are reasonable ranges. These are tradable ranges. If SPY is up 12%, something amazing is happening. If SPY is up 12% in 30 days, something amazing is happening. If SPY is down 12% in 30 days, something likely very bad is happening, So of course, we don't want to think about the black swans. We want to say, okay, I got a 70% chance the SPY is going to be up or down 3 or 4% over the next month. I can capitalize on that, and that's realistic. So that's why we want to use VIX. That's why you don't want to care about it intraday. You want to use these numbers. You need the chart for nothing more than to tell you where VIX is at. VIX is at $15.80. As of right now, the market has priced in a up or down 4% move on SPY over the next 30 days. Or well, SPX, but that's it. That's what it's telling us. And there's a 70% chance that's going to happen. And could SPY, very, very easily be up or down $10 to $15 over the next 30 days? Absolutely. I mean, I believe in that statistic. I think everybody should believe in that statistic. Kind of the no-brainer for us there, Are you getting it? Have I explained it? Happy to explain more if we still aren't there. I get it that, I might view it as simple, but maybe it's not simple at all. I'm just used to looking at it. And anybody else, you have questions? Completely lost. Oh God, here we go. Okay. Yeah, okay. So basically, um, uh, so is that percentage of it will close within the range? It is not, it has nothing to do with closing. Georgian, you ain't tricking nobody. You are smart. I know better. So it's nothing to do with closing. It is nothing to do with opening. It is, oh my God, Ricky, you guys are going to make me jump. So nothing to do with closing the month, nothing to do with opening the month. It is telling you there is a 70% chance that in the next month, SPY, and let's see what SPY's trading at. I don't know, we're gonna call it 600, So we'll say SPY's trading at $600. So at $15, it's telling us that we got, and we'll say 14, because for easier math, SPY's trading at 600. It's telling us that we got a 4% chance or a 68% chance that SPY will be up or down 4% over the next 30 days. That is $24. And so that's very, that's reasonable. These days, as crazy as it sounds, SPY is expensive now. So that's reasonable enough. I would believe that SPY could be up or down $24 in the next month. That's like, while it sounds like a lot, of course, if SPY was 300, it would be even less, but that's pretty dang reasonable. And we as traders should believe that, like, could SPY be at 620 next week or in 2 weeks or in 3 weeks? Yeah. Could SPY be at 580 next week, in 2 weeks, and 3 weeks? Absolutely. So we believe that, good 70% chance there. Well, if we come out to these outer numbers, and we got SPY at $600, we're just pretending, and you have a 99% chance that it will be in a 12% range. So would you agree that it's almost guaranteed that SPY will be between $672 and $530 in the next 30 days? I think that's a guarantee. So that's how we want to use it and view it and say, I would consider that 99% chance pretty dang reasonable. Does it give us any useful information? No, because yeah, of course, SPY is going to be in basically $140 range over the next 30 days. That doesn't help us. When we look at this one and we say, okay, it's not quite standard deviation, but in a way you can use it. Like, the market has, and so when we discuss the market pricing things in, and that's what VIX is doing, it is pricing in the volatility. Oh, I can probably show you. Okay, so, the market prices in volatility. And how does it do that? Okay, let me make sure I'm not going to share anything. Oh, this one doesn't matter. I forgot. It's a small port. Okay, how does the market do that? So we have great examples going on in the market right now, and a place that you can check it. So here you go. The market makers priced in a $6 move on Hood for its earnings. That's what we see right here. So that's why those contracts were a little bit expensive. Generally the market makers are good, so you can look at it, and we can go to, we'll say, SPY. And now if we go to, oh, we got to pull it over a little more. So now if we go to SPY and we look at these contracts and we go to next March, here's the monthly contract. They're pricing in a plus or minus $25 move on SPY. Well, we already knew that because that's what VIX is telling us. So that's how we use it. What VIX is telling us is, how much do the market makers think we're going to move? So if we start thinking of it like standard deviation, if in a month we have found ourselves at 624 or whatever it is, ease off the longs, because the market makers are going to start to be like, okay, we're getting a little bit worried here. We're about to get blown out on the long side, like, we did not expect this move to actually happen. So it's not necessarily standard deviation, but it is giving you a very, very nice range to work in. We can even, a great one, obviously. So we had this explosion. This was the carry, the Japan carry trade. So they were basically using their money to borrow other money to buy other currencies to prop up their economy. It's not as uncommon as you might think, but they had to unwind that trade. And so we can see, that was right back here, that's where this happened. That's where this happened. And so we can see right there that the VIX absolutely exploded. This thing doesn't even go to 60. Well, the market got clobbered. I mean, the market was down 10% in 3 days, just about, maybe not quite that much, 10-ish% in 3 days. VIX exploded, obviously started to settle out somewhere here around the 20 or 30. Well, at 30, it's telling us that there's a 68% chance that we will be up or down 8% from here. In a bull market, we can obviously start to look at that and say, upside seems like the more likely. And so here's the carry trade, and the bounce off of the carry trade ends up giving us 9%. So VIX priced it in perfectly when it happened. And then you see, by 30 days later or whatever it is, here we are. We've made that move. So the market makers are good. Does everybody get that? Are we getting closer? And again, I'm happy. If you don't, I'm here to teach. So ask questions, you know? What is what is implied volatility based off of? Um, really hard math. Um, but it is, let's see if I can find it. Give me 1 second. Um, all implied volatility is telling you is so I wanted to show it to you. So it's the Black-Scholes model. It's how and that's BLACK hyphen SCHOLE. So it is how you calculate, it's how you calculate IV. I'm trying to find a good screenshot of it. And what IV is telling you is just, again, you can kind of use it to a similar thing. You know, obviously the numbers are going to be different, but when you see IV at like those hood contracts, they were 150%, they're pricing in a 10% move. That's what you get from IV. So, um, so if you're a mathy, you know, you like your math, here you go. This is how you calculate IV. That was kind of why I laughed when you asked. I don't do this personally. I let them calculate IV for me, you know? And so that is all IV is doing. And so you can see, I will point out the one thing to here, theoretical call premium, that is what you're seeing. So those, you know, we can even go back to them. Yeah, exactly. That's like, I mean, that kind of stuff just makes my brain melt, you know? So we can go back to these hood contracts. Uh, oh, well, unfortunately, they've already adjusted it. So these contracts, so for example, these 65 SPY calls or hood calls, weeklies, they were $84 at close. Robinhood was at $55 at close. Well, because they had a $6 move priced in, what that is telling us is, okay, Robinhood's at 55, but the cost of this $65 contract is what it would be if Hood was at $61. So that's what pricing in that when you hear, you know, pricing in implied volatility or the market maker expected move, that's what this 3Ms and this little number up here are. They were expecting a $6 move. We were trading at $55. They were expecting it to get to $61. So they were charging you the price of it already being at $61. That's quite literally, you know, that's the big part of IV Crush is you got to get past that expected move. Then, if you want to start to get more technical, your IV will decrease and Vega will tell you how much contract value you will lose for every 1% of IV. So, you know, if we're at 67 and you're going to lose, you know, $40 and you're going to lose $40 of, you know, or 40% of IV, you're going to lose $80 of contract value, which is going to be most of your contract value. That is IV Crush. However, you also have to take into account delta, blah, blah, blah. But that's what IV is. That's how it's calculated. Obviously, I don't do it. I just look at the number it gives me. Okay. Great class. Great questions. Thank you, everybody. Small attendance tonight. Love those kinds of classes where everybody can ask their questions. If that's going to do it, we will call it a night here. And thank you, everybody, for being here. I appreciate it. Yep. Right on, everyone. Thank you all so much. Yep. Yep. Have a great rest of your night, everybody. We will talk to you all tomorrow. Thank you. Yep. Yep. Thanks all of you. Thank you. Thank you. We'll catch you tomorrow.